Welcome to our eSignal Weekly Forex and Futures Forecast. My name is Jay Norris. I teach trading at Trading University. First market we'll get to will be the Australian US dollar. Big shift up in the Australian dollar. Remember last time we were together we talked about that resistance level there. Interestingly enough, it gave us a nice little trade off of there against there. Then it came back, popped through it. It shifted that big 50-day pattern there up. So from a short-term trader perspective, swing traders perspective, we're buying dips. On the other hand, we have to be aware that, look at that, the rally took us right up to that high. That high happened to be the 50% retracement level of our secondary pattern. So right away we're into secondary resistance just below 74 even. Short term, intermediate term, we're buying dips. Long term, we're where you have resistance there. So anytime you get up into that zone just below 74 even, you have to be aware of that. So I think until we can get we can clear that out, clear that resistance from the October high, you really have to be careful on any rallies as far as holding longs. Not a whole lot of room on the upside for the Aussie now, so we'll have to see what happens. I think buying a dip, it'd still be the way to go, and just be aware you have resistance up above. Next market, the dollar Swiss. Big pullback in the dollar Swiss. We love it from our perspective because our MO here overall has been buying dips in this guy, and there's a big one to buy. I'm highlighting the 50-day pattern on all our charts because that for us is your most significant pattern overall. So the 50-day pattern is up and you're dipping into support there. Ideally just below 98 even is going to be the best price to buy that. Our ratio says it all. One day, Thursday, when the ECB spoke, you shifted your 10 and 25-day patterns down simultaneously. That's a big event. You have to address that from a short-term trader's perspective. When the 10 and 25 shift down simultaneously like that, there's no way around it. As a day trader, we're shifting from buying dips to selling rallies now. So as a short-term trader, we're selling rallies now. However, a longer-term trader, we're eyeballing this level here, right around 98, the figure there, as a big level. Down in here we call this trade the trade of the decade. And now essentially it's the investment of the decade for us. No doubt that is still the case for us. Let me pop out to a monthly chart. Gave you scale here long term. Look at that beautiful breakout you had on the monthly at the end of November. So you have a nice breakout long term. Looks like shorter term popping back down to that daily chart. The market's going to pull back and test that breakout, but we love this market. It's really almost in a position here where it's close enough to where support, where you almost want to start sticking your toe in the water there. From a trader's perspective here, let me drop down to a 4-hour chart. Trader has to be very patient here if you're going to use leverage. We talked about this a few weeks back. How I was saying I'm long this guy, but I don't have any more leverage. Basically, just a smaller cash position. Now's the time to reconsider going long with leverage. Pop back out to the daily. There you go. So definitely interested in going long again using the leverage. Overall, maintain your cash positions for sure. Trade of the decade here coming up again. Investment of the decade for sure. Dollar index, next market. Similar story. Boy, the dollar held up pretty good though. There's your 50-day buy zone. You can see same story. You shifted all these shorter term patterns down simultaneously. Boom. You have to account for that. As short-term trader, we're actually selling rallies, meaning on an intraday chart, we're selling rallies in the dollar here, buying dips in the euro. We'll get to that next. However, from an invested standpoint, longer-term traders' standpoint, we're definitely eyeballing this buy zone down in here for, what we'd continue to call the trade of the decade. So big support level coming up. You got to be patient on that. If you're entering a cash position, a smaller cash position, that's fine. You can start to eyeball that, consider nibbling. But if you're going to deploy leverage, which is a little bit more dangerous, certainly a bigger position, then you want to be patient and hold back, try to keep your powder dry until you get closer into that buy zone just above 96, the figure there. Big level, 96 the figure. We'll be looking to go long at that level. Here's the euro. We were talking to our students. We got the big shift in here, right in here, in late October. You had the big shift down here. Beginning of November, the market really started to accelerate lower, and we were hoping once you got that shift to get a rally to sell. You never got the rally to sell. Well, that's okay. You got a big sell-off. That worked for us as short-term traders trading the intraday charts. Now finally we get the big rally to sell. So here you can see I've got my 50-day zone marked on that chart there. Same story, just the reverse of the Swissy. Shorter term patterns are up, therefore we're actually buying dips intraday. However, the closer you get to what is that 111, the figure, you get into a nice sell zone there. So this is definitely an area of the chart where we'll look to deploy leverage, take aggressive short positions in that area. And it's another one where I highlighted the 50-day pattern. You can see that 50-day pattern, the most important pattern that we see statistically over time as being the most influential pattern. So that's a pretty important pattern. So you got a little bit more room here to climb before you can get in that, before we can let loose with leverage positions. However, longer term, you carry a smaller cash position, you could consider nibbling. I guess you get above 110. But just be patient with the leverage. Meantime, if you're a day trader, nothing wrong with buying dips in this guy going forward, which is kind of fitting. You're getting into the slowest month of the year. From a seasonal standpoint, statistically, December tends to be a slow month anyway. So it's a really perfect time for the market to take a breather, start to see some sideways counter trend action. Ideally, those holiday market rallies will take us into this zone, into the new year, and then we can really let loose with some nice leverage positions, have some nice size on and make some good money when the bear resumes in the euro. Gold market. Gold kind of late to rally. The euro rallied first, then gold responded. Gold's been a leading indicator on the downside. We think that'll definitely continue to be the case. And basically, if it's leading on the downside, then it's going to lag on the upside, right? A long way to go before you can get up to resistance in the gold, the 50-day resistance anyway. In the gold, the other markets I had the 50-day pattern highlight, that's still my 25-day pattern highlighted. So 25-day pattern still bearish in the gold. So we'll continue to sell rallies in the gold overall. Gold, not the most liquid market anyway, heading into the holidays here, heading into December and a little beyond. I'm really not interested in gold as a trade. Always watch as an indicator, though, for sure. Speaking of indicators, here's the market to watch. 10-year interest rates. This supports our whole fundamental thesis overall of strong dollar thesis, weak euro. U.S. interest rates. Look at how the rates jumped here. The same day the same day the ECB said they're going to ease, U.S. interest rates jumped. Overall, that's very bullish for the dollar itself. Very definitely supports our overall bull dollar thesis. Here's a market where all the patterns are higher here. Basically, U.S. interest rates pointing higher. You're at 2.3 for the 10-year. We don't think it'll take much now to get above the summer high there, which is just below 2.5%. So we see higher interest rates on the horizon, and that's going to be dollar bullish. Let me pan out to a weekly chart here, give you a little bit longer term perspective. And here's what we're thinking overall. We believe that U.S. interest rates bottomed here in the summer of 2012. The summer of 2015 here, you put in just another higher low, right? So you have a long-term pattern of higher lows. That's why the dollar has been so strong over the last year and a half or so. And we see that as really just the beginning, because when you scrunch that chart up, you see, boy, you have a lot of room up above for interest rates. Conversely, you have a lot of room up above for the U.S. dollar. My name is Jay Norris. I teach at Trading University. Thank you so much, and we'll see you next week.